Hello, everyone. Welcome to the Index podcast, where the three of us come together every couple of weeks to discuss chart crimes, happenings in the crypto industry, and in general data. Today, we are joined by two guests, so that makes us Denning, researchy Corgi at Flashbots,
Hello.
Hildoby, resident data householder at Dragonfly,
Hello.
Ludwig, chief karting racer at Sorella Labs,
Hey guys, thanks for having me.
Joseph, general meow and full-time data daddy at Sorella Labs.
Hey guys, thanks for having us.
And I am Boxer, and I am the community powerhouse at Dune. Before we get into the meat of this episode, nothing we say here should be relied upon as legal, financial, investment, tax, or even life advice. We are acting independently of our respective professional roles here. And with that, very happy to have the data daddy and the chief karting racer from Sorella Labs on the podcast to learn even more about MEV data. So this is a continuation of our MEV series. And first of all, Ludwig, Joseph, maybe if you could quickly describe your respective paths to kind of founding Sorella Labs, that would be great. And maybe Ludwig go first.
Yeah, so I started off in my first year of university, U Chicago, got really into DeFi and started providing liquidity across like many very questionable chains. So I was in Harmony, Phantom. I was basically moving like LP funds everywhere. And I was really frustrated with the solutions that existed to like make that job easier. So I like started learning about MEV to try and automate the entire thing. And that really just got me into the whole rabbit hole. But I came to realize like you can't really do it profitably because LPing kind of sucks right now. But that's a topic for a different day, probably.
Yeah, similar with me. I was at U Chicago. It was my second year, and Ludwig and I had been friends through another vein at the time, not through crypto. And he was talking to me about it, telling me what he was working on, his whole LPing. I just found it really interesting. I thought that the space in general, or at least the way he portrayed it, was at the intersection of a lot of interests at my time: math, computer science, economics. So yeah, around that time, I joined him, and was part of the Sorella founding team.
Okay, cool. So you guys basically met in university or like in some other avenue outside of university, and then you both went down the DeFi rabbit hole, and then finally you were like, okay, let's like providing liquidity, all of this stuff, let's just build MEV kind of related tools. Is that kind of the story?
Yeah, kind of. So first we kind of tried to build like a system that was very similar to a lot of the like MEV style infrastructure to like track the mempool, like understand what flow was coming in, and aim to optimize the like liquidity allocation across pools. So trying to do JIT liquidity provision, and generally just have an optimizer that could allocate to different pools when yield was like quite high. But we realized that was just a terrible idea, because if you're going to build out all of that infra, there are a lot more things that you can do that are far more profitable and far easier. But most importantly, that there's a reason why the most sophisticated players aren't providing liquidity right now, and that is because of some of the MEV that we're going to talk about. It just makes it completely unprofitable.
Okay, so but you were kind of going from I have this one specialized tool of like that I'm gonna build for my own use cases to okay, like there's actually a broader story here, and like if we zoom out, there's like more interesting things to do.
Yeah, it was like very targeted in the beginning, and then kind of coming to learn like the space throughout.
Yeah, I see. So that brings us to what does Sorella Labs actually do? What are you guys cooking?
Yeah, I mean, so our main focus, is Angstrom. It has been for some time now. And before we went up, or we're attempting to solve the problem of LVR, which is brought on by Sextex arbitrage from centralized to decentralized venues, which is one of the types of MEV we will be talking about shortly. But before we did this, we kind of sought out to quantify the issue, how much LPs were losing from centralized to decentralized arbitrage. And so this was the inception of Brontes, which, as Ludwig said, then went on to become some sort of a generalized MEV, data project / tool. But yeah, our main focus is definitely trying to make LPing profitable, and trade execution better, right? So I'd say that's the central ethos of what we're trying to build out right now.
And to expand on that and give like a easy to understand explanation of what LVR is, loss, it's an acronym for loss versus rebalancing. Basically the idea is to say, okay, if you were to have a rebalancing portfolio, what would the performance be compared to just liquidity providing in the pool? And then comparing those, you can quantify the loss versus the rebalancing portfolio, because an AMM should mimic that rebalancing portfolio cluster fees, in the hope. But because of the lack of information and the complete asymmetry of information that occurs, where liquidity providers don't know like how prices have evolved off chain on the more liquid venues where price discovery actually occurs, they're selling these assets at the wrong prices, and they are filling in bulk toxic flow. So you can imagine them just every 12 blocks or so selling and offering their liquidity at a significant discount. And that's like very, very unlikely to be profitable, except if your assets jump up in value exponentially. But then again, you'd be better off just holding them. So yeah, our main focus today is to solve SexDex arbitrage and make on-chain markets sustainable, and also prevent sandwiching to ensure that users get the best experience. But overall, I'd say like our broader mission is to tackle the MEV problem at the application layer and take back control from the proposer, from the builders, and back to the application, because I think that is the like largest problem in crypto today, is that as apps, we care about our users. We want them to get the best execution because we want them to be returning customers. But as a proposer or builder, your incentive is to make as much revenue as possible. And that goes, that happens by extracting revenue by creating inefficiencies or just executing various forms of arbitrage. So if we can bring back control on how these transactions are actually executed, we can ensure like optimal outcomes or close to.
So does that sound like basically, so Angstrom is as I understand, a V4 hook design AMM, and this AMM is supposedly will be able to capture MEV or somehow protect the LP and redistribute back, or is that the right way to think about it?
Yeah. It's I think that the biggest, like the easiest way to understand it is that Angstrom's not so much like a novel AMM design insofar as like the underlying, a curve that's being used or how the liquidity is disposed in the smart contract, but it's really about what happens before things get executed, before the swap is actually, accepted by the pool. And the idea is to say, okay, we've got these builders, we've got these proposers. They're making a lot of money because these arbitrageurs are competing against each other to get the right to arbitrage. So they're already paying someone to be able to execute this arbitrage. The problem is that they're paying the builder and they're paying the proposer. But if they just paid the LP, the bulk of that value would go back to it. So what you do there is you create an auction system that isn't bypassable. And so these bidders have to go through this auction to be able to execute their arbitrage swaps. At the same time, we do like frequent batch auction for regular users. So after the arbitrage gets executed, we have this off-chain order book through this like off-chain network of nodes that we form consensus on. And so we can match users against each other and also pull AMM liquidity and market maker liquidity to form all of that and combine it into one batch where everyone settles at the same price. And that you get order agnostic execution, which prevents the sandwiching problem.
Okay, a little bit quick clarification on the things you said, like what is frequent batch auction? Because I understand, like, for example, CalSwap is doing a batch auction, as in like it will wait for multiple orders to put them together and submit on chain if it makes sense to have, when they have a higher price improvement. Is there any difference between like frequent batch auction versus batch auction, or how is it
I think
different?
sorry, I cut you off.
No, how is it different from CalSwap?
It's different in the sense that CalSwap doesn't control the underlying liquidity source, and solvers are competing against each other to clear an entire batch. Whereas for us, the network has a deterministic rule on how it has to clear the batch. So it's not about finding the optimal route and pulling liquidity on chain, but rather it's about taking all of these orders, matching them against each other, identifying like the intersection between like the demand and the supply curve, so the bid and the asks. That forms your uniform clearing price, and then combining all of those, compressing them down, and then settling them on chain every block. So it's different in the sense that you're not relying on like different solvers to compete, but rather the network itself has rules to take all of these orders together and then process them deterministically.
Okay, I see. Does that sound like your batch will include not only the swap trade orders, but also like the LP orders?
Yeah, you can have market maker orders, you can have regular user orders. They aren't really differentiated because they're just like represented as limit orders. But that's combined with the arbitrage swap as well, because you can just compress them down into a single actual swap, and then you're basically just doing transfers at that point. So in terms of gas cost, it saves you a lot, but it also just enables you to pull a lot of liquidity from different sources and not just the AMM.
Okay, I mean, so I think like we know that Sorella Labs is building not only Angstrom but also Brontes, and Brontes was released like I think a few weeks ago, a month ago, and we're very curious about this data tooling because we're all like data wizards or like data nerds here, and so yeah, I mean today I think we would want to know like how to say have a deeper dive and look into the Brontes data and how you guys started building it, like what is the tech stack. And then, like getting some insights from you guys. And so, I guess I'll start from here because I prepared a bag of questions. So, why did you guys start building Brontes and what it is about?
Yeah, so Brontes, originally came into inception as the idea of quantifying this loss versus rebalancing, as Ludwig said. It had been theorized, but it hadn't been like proven. There had never been a number put to the term yet. So this was the original goal. And at the time we were still learning. We started building at probably about a year and a few months ago. So we were still exploring different types of MEV a bit more deeply. And in doing this, right, we were like, why not just turn this into a generalized, MEV detection mechanism, right? So that's what we did. That's that was the progression.
Yeah, I was gonna say to expand on what Joe just said, like you can't really just identify one form of MEV. You're kind of forced to aim to classify all of them because like we have an entire deduplication pipeline after. Because otherwise it's just all overlapping. An atomic arb kind of looks like a sextex. A sandwich will look like a backrun if it's seen in isolation. A JIT that isn't considered a JIT sandwich will be evaluated as a JIT, which is also in some sense a sextex. Like it all gets super messy. Where if you like don't run all of the inspectors at once, you get misclassifications because the pattern matching that you're doing will match on specific like subcomponents. So you kind of have to create this like hierarchy mapping of MEV, which is super annoying to do, but was a fun challenge. But yeah, overall, like tech stack wise, it's built on top of Ref. It uses Alloy, and it has like a local libmdbx database, and we have like a whole data warehouse on the side. And so you can run it by just downloading the snapshots. And if you have a Reth node, you can kind of customize and create your new inspectors, and we try to make it as modular as possible there.
Right. So it's actually a open source repo right now, and anyone can spin up a REST node and run it. But it's only Ethereum right now.
Yeah, it's only Ethereum. It could be applied to like any other EVM chain pretty easily. The only thing you'd have to change is the address list, because we basically created these proc macros where you can just pass in an address and a function signature and easily like decode any data at the trace level. And that doesn't manage multiple factory addresses per chain. So if someone was to create a PR for that, that'd be really cool. And then you could easily go on Optimism or any other EVM L2.
Yeah, I think that will be very interesting, because right now, like, we also have zero idea of like how much L2 and MEV is happening, and if there's a tool that can be applicable, that would be cool.
One of the constraints, obviously, being that faster block times, right? Brontes is quite fast, right? But there are some limits. When you start to get into the like low second block times, right? You might run into issues with being able to keep open chain tip. Another thing is tokens, right? I know Base, there's a ton of token deployments, unlike the L1. And this might, increase the graph complexity when actually calculating, trading prices, that tip. But for the most part, I think it's pretty modular enough to be able to adapt it to, run on any EVM compatible chain, with maybe a couple exceptions. But
if you don't mind, Joseph, we want to walk us through the whole dashboards and Explorer, so we can have an idea of like what exactly the information and insights Brontes is presenting to everyone. That would be great. And I mean, sure. I expect Boxer and Dobby will have a lot of questions. When we are diving into the numbers.
While you pull that up, I think kind of stepping back a bit, it's like the motivation for building this data pipeline is probably to prove why do you even need your Angstrom product, right? It's like
exactly.
without MEV, it's like, okay, like what are we actually helping to prevent? And it's like the best, like we see companies raising on Dune all the time, or like, hey, this is a problem we can solve. And like you show that data. And this is kind of this is one variant of this where you're like, hey, like we built this tool to like look at this problem. And now we're kind of like hoping to solve this exact problem with our product that we're building. So I think that's very interesting, and it's probably like going to be really interesting once the product is actually live, and we can hopefully see the impact that your product is going to have on the MEV landscape.
Right. Yeah, that was one of the hopes, is to like see the decline after, ideally. Yeah. It was also in part, I must admit, like just really cool to build. But yeah, that was probably like most of the justification was that.
Yeah. I mean, I think like one thing to admit is that like data is the best marketing. Like these days, like if you see all the decks are fighting on Twitter, they're like, no, we have better price. The other ones are like, no, we have better price, but like just show me the receipt from the chain would be the best. And so people would understand, okay, you have better price. So yeah, I think it makes a lot of sense. Yeah.
Yeah, this is our dashboard view. One moment. Sorry. This is our dashboard view. We're showing the tip, all the data that's currently happening, 15 blocks behind, because Brontes needs time to run. So yeah, I guess I'll start with the mempool highlights. Basically, we shout out Chainbound first of all for providing the mempool data. So what we have here is we've defined all the public transactions that occur in each block and assigned them a ranking based off some some heuristic, albeit like a victim transaction like this current one, being at the top of the list, right? And then we will show in real time, or 1000x, I believe, the propagation of this transaction from different nodes in the network, right? so you can kind of see where your transaction is going. You can get a brief little info in this box in the bottom left. Now over on the right for the value over time, this is showing the bids and values as the slot progresses, right? And I think this is really cool because it's quite indicative of timing games, right? You're able to see some of these bids being submitted post the actual slot time, right? Along with their values highlighted below. Down here we have the latest block, just like you'd see it in the block explorer. I guess this block is empty. Just wait for the next one to go down to here for now. Yeah, this is showing the MEV over time and different statistics that go along with this, right? We have profit, revenue, average profit margin, bundle count, top searchers, most arbs, pairs, pools, and dexes, right? This is also a cool feature because you can kind of select a combination and the statistics will change with that. Yeah, sorted by profit or revenue, both is quite interesting as a view. And then for the Explorer, yeah, we have searcher and builder statistics, including funds associated with some of the top searchers. And this can be viewed in different time ranges up to 30 days, right? And on the right, we have MEV specific type or MEV type specific statistics for these time ranges, right? Kind of similar to the MEV over time, just constrained by time. And then down here we have the latest blocks and bundles that have happened on chain. Top fund is we have a list of addresses that we have associated with different funds. So the top and the top searcher is just an address that we don't have associated with any specific fund.
Okay, I see. And just to understand the definition of when you say like revenue and profits, the MEV revenue, is it actually like say the proposer revenue, or is it like the total extracted revenue from the searching transactions?
Where specifically?
So for example, here like on the left, there is total MEV profits, which so like I'm trying to understand like say, because there is a process of like say there is a sandwich and there is total of say $1 million extracted, and out of that there might be like 500,000 sent to proposer builder, there might be 500,000 kept by the searcher. So how are you calling all those terms?
Revenues before cost, before transaction inclusion costs. So before the payment to the builder, like before consideration of like just transaction gas cost and priority fee or like bid to gain inclusion.
Right. So it's like the total extracted profits from the searcher transactions.
Yeah. And maybe we can go into the latest blocks and the bundles and show the analysis tab there. I think that would probably be quite interesting.
Yeah. So this is now I guess I'll start at the table. This is the block view that we have. We highlight some basic statistics on revenues and fees paid from the builder. And then we also highlight the different bundles that happened, the different bundles that happened in the block, right? So we have a sex dex, sandwich, and atomic arb in this one. And then if you go over to analysis, right, you can see the slot auction again, similar to how you would see on the dashboard. And then you'd again see some more stats on the actual specific types of arbitrage that occurred in the pool. Yeah.
And the block is like the space that each color occupies represents the bundle's like relative profit compared to the other bundles in that block. And if you could switch to revenue, we can also show the relative revenue as opposed to the bundles, like bundles and all other transactions. So here you can see basically viewing based on the thickness, how much each of these bundles contribute to the general value of the block in terms of base gas, priority fee, or builder tip payment. Other like cool thing that we can note here is in terms of builder P&L card. So you have like the baseline builder P&L, and one line probably you're seeing, and you might ask yourself, what does that actually mean? Is the builder MEV profit. That's accounting for the MEV profit of searchers that are associated with that builder address. And this is like really important to have, because without it, you cannot see like real profit numbers, because they can obfuscate their P&L by just overpaying to the builder. And so some builders are known to do this, where they will just send these huge tips, basically 100%, if not more, of their revenue to their builder, because it's the same entity at the end of the day. And you can only see the profitability within the builder's underlying P&L as opposed to each individual searcher. And so that makes it a bit more annoying to track it. And then if you could click on the gossip tab, there we go. And then with the gossip tab, you can see the relays and like the relative timestamps of when the relays received it. And you can also see the P2P timestamp of the block. So when the block was first seen by other nodes after the relay released it.
I see. Yeah, I'm curious who is the winner here in terms of like the first one to see the transactions. Is it blocks route you guys see most often?
I'm sorry, just to clarify, the first to see the blocking?
As in like the relay?
The first one, like for example, here it's representing who is the relay seeing the block first, right?
It's ultrasound and
these
blocks route.
Yeah. Yes. Sorry.
Flashbots is kind of lacking. I'm not gonna lie. Like we see your deltas and it's pretty gnarly. It's pretty bad. I think it's because they're like, it kind of makes sense now with like the so you have the optimistic relaying, which was like the talk of the town for a while, but now it's mostly bid adjustments. And that we track that as well. Oh my God, what a pain to track that was. They will basically, like relays, to explain, relays will basically look at how much the second best bid is, and will modify the block to penny the second best bid, and will split the like basically the value that they've captured between the builder and the relay. Ultrasound was the first to implement this. Blocks route implements this as well, but they want a lot of money for it, I believe. So it's like unclear who is doing that there, and we can't track that because the addresses aren't public. But for ultrasound, we have all of the addresses, and so you can take that into account. And a good amount of blocks from the top builders are like benefiting from this.
It's also just in general pain to implement, because the winning block, the bid for the winning block, the block hash isn't the same as the block hash that's actually submitted on chain, because the relay will add an extra transaction at the end of the block to be posted on chain, so it'll have a different block hash, right? So it's not as simple as just looking at the block hash of the bid and the block hash of the actual block that was posted. So yeah, just a bit tricky to navigate.
How do you manage to just remove that last transaction and recompute the hash, or?
Well, thankfully, ultrasound does have an endpoint for matching the payload that was delivered and the bid that was asked for.
Yeah. So I saw Boxer had a question phase. So like if I would iterate on what I understand on like bid adjustment, as Ludwig already explained. So basically, like there are these performance relays, like ultrasound is the top example, and they are better at latency and they receive the blocks faster. And so they were thinking about, what if we hold on the block value? Supposedly if you have better latency, you would receive a block with a higher value and more pending transaction in the mempool compared to other block being delivered by relay, if that makes sense. Because the transaction in the mempool comes in every millisecond, and if you get the later block faster at the same time as the other relay with the previous collection of mempool transaction, your value is likely higher than others. So that's kind of like your edge brought out by your latency performance like advantage. And so then at this point, ultrasound would be like, I will check if the second highest bid lower than me, how much value is that? And I'll basically only submit as same value as that bid to the proposer. Theoretically, I just want add one way. The proposer, if they're rational, they will accept my block instead of the others, if that makes sense. So basically, like they don't need to bid their full value. They only need to bid a second price auction. So like basically, whoever the second winner is bidding, they will pay for that plus one way. And so the delta here, we call it surplus. They will split it with the builder who submitted the bid. And so, but then here is the like implementation details, right? Like, so when they receive a block from the builder, they will have to, in the end of the block, the payout to the proposer is a fixed amount. And when the ultrasound needs to adjust the bid, they will have to drop that transaction and create a new one. And the way they create a new one is by adding a transaction sending from the builder's collateral address with them. So like basically, for example, when I have to like, I'm a builder and I need to send my block to ultrasound with like the optimistic bidding, I will have to spend like, I don't know what's the current threshold, but say like I need to deposit 1 ETH to make sure I don't behave badly. And so if I behave badly, they will slash me, just like optimistic design. And so that's my collateral. And they will have the access to my collateral address balance. And so ultrasound at this point, they can basically remove your last end of block payment transaction and change it to a new one that's sending some funds from your collateral address they have access to. And then in this case, the block is new because the end of block transaction is new. So then the block hash is different. So now like for them to map, okay, this block landed on chain, but the block hash is which one from the bits that ultrasound received is very tricky. And I think a way to do it, it could be like, yeah, I mean, I don't know the details, but it sounds like you guys are like just checking the values and trying to do the calculation.
You have an API.
They have an API endpoint that will give you the bid block hash and the block hash with the modified transaction.
Yeah.
Yeah, I don't know if that made sense, Boxer. I was rambling. Yeah. Okay, cool. Yeah, you guys also mentioned some other like earlier you mentioned like the builder profits was also adjusted based on like the vertical integration. So like in the case of say, you know, we know like a CP trading firm is basically also Beaver build, and in a lot of cases they have their own searching transactions included in their block, and sometimes they don't need to send the searcher profits to their builder. They can just like let the builder address pay out whatever the theoretical profits coming from the searcher transactions. And now if you only check the builder addresses balance change, you will think, oh, are they subsidizing a big amount of funds, because you don't see anything that's receiving to the basically the fund coming into the builder address. So sounds like you guys accounted for that cases.
The most annoying is when like it can arise in two situations, right? Or your bundle is super profitable because the builder's paying out, and that's fine because you still classify the MEV if you're just doing baseline pattern matching, and then you can just do like entity level accounting. The more annoying one is when they're overpaying their builder, and so the searching activity seems deeply unprofitable, and then the builder just happens to be extremely profitable on that block. Because then now in your underlying like pattern matching and evaluation of what constitutes a bundle, you can't base yourself on the like general assumption that a bundle should be profitable. And then there's like backdoor deals as well that come into play that also muddle like the profitability. Like the two top builders will look extremely profitable at times, and some searchers that are, that love gastronomy, if you catch my drift, and very much into food, will look deeply unprofitable on a lot of their bundles, and you're like, suspicious. So yeah, that muddles the picture even more. But you can attempt your best, but you're realistically never going to get perfect profit values on all of these.
Yeah. Cool. Yeah. I mean, so I would love you guys if you can share some examples from Brontes that captured, because we're trying to make this series as like a 101 intro to any data wizards or person who is interested in getting into MEV. So we probably should have like a very, like 101 session about like what are all type of MEV we're talking about? Like what exactly do they look like in terms of transactions? So I think Brontes might have some like cool example visually as well to look at. If anyone of you want to share, yeah, cool. Yeah, I'm interested to understand like what are atomic MEV, what is sexdex arb you're talking about, what is sandwich, what is JIT, and everything. Yeah.
Yeah. So I have a few examples pulled up. This one is just a baseline sandwich from our good friend Jared. So basically how it's laid out, so the sandwich transactions will be highlighted in red. A sandwich is a front run transaction, a victim or multiple victims, and then a back run. Front run pushes the price of the AMM up. The victim buys the asset at this inflated price, and then the back run brings the AMM back to the true price and extracts a profit from the whole ordeal. A few interesting things to note in terms of just using the UI generally. So we try to simplify the view as much as possible in terms of what's going on in a transaction. And so we break up transactions into core actions, which you can see here. And you have classified and non-classified actions. An action is just like a trace that happens within the transaction. So here you can see it's simply just a swap. You have like transfers. You have like builder tips to show you builder payments as well that we'll probably see in other transactions. But if you want a like more in-depth view, you can toggle the all, where you'll see literally all of the like calls that were made within the transactions. And so this is really basically the lowest level of granularity you can get. Interesting thing to note here. Jared tends to almost always sends a very small amount of value when he calls into his contract. And this is not for the purpose of like funding the contract whatsoever, but we assume that it is cheaper to encode instructions within the value field and interpret it from that rather than have larger call data. So you can always see like a tiny bit of dust being sent over. And this just goes to show like the crazy shit that MEV searchers will do to save like however many gas.
Wait, hold on, wild. Just to make sure I understand this correctly. Instead of sending hex data, they encode data within the value field, and that makes it cheaper because you don't pay additional gas
call data.
Okay, wow.
It can be cheaper to. I'm a bit dusty on this stuff because I haven't looked at like MEV bot smart contracts in ages. But if I remember correctly, you're saving on call data because you're not encoding these instructions in call data. So you can have a specific like special value that you encode in the message.value field, and then in your smart contract you just interpret it and you match to that like kind of scenario in which you can execute your actions, which is kind of sick to see.
It's the same innovation of how people use it. You see call data for what's that thing people are trading?
Are you going to say inscriptions?
Yes. Oh yeah, inscriptions. Yeah.
Okay. Oh yeah.
Yeah, quite similar.
Yeah. So MEV searcher invented an inscription first.
Way before. I mean, they were doing the messages like way back when. This is one of the cooler features, very much an alpha. We should have made the alpha tag a bit bigger, so it's a bit buggy still, but it kind of works. Where you can basically see the transaction tree, so you can visualize the nestedness of each like trace, and you can kind of play through it. And so if you go to the left here, you can kind of play through each action, and then you can visualize what's going on. So here we have a bit more complex of a call. We can move through. Okay, there's the the first transfer, then the swaps, then the calls, and more transfers. On the left here, you have like the net balance changes. So you can see the difference in balances for each address, and then you can kind of filter and select whichever you'd like. And then other small details that might be interesting. Here you can see if a transaction was seen or not in the mempool. This isn't always 100% reliable because like the coverage isn't necessarily perfect. But here it says that the victim transaction was not seen. I'm not sure that's true, but it could be. There's some weird ways that Jared gets is able to sandwich on private flow. So yeah, that's a bit of an overview of a sandwich. Now we can move to slightly more complex version of it, which is a JIT sandwich. So this is kind of the evolution of the baseline sandwich, which is
maybe we should do JIT first.
Yeah, but I want to do JIT, but it's JIT sexdex. And okay, I'll just explain what a JIT is, and then we can. Yeah. So a JIT is just-in-time liquidity. So on concentrated AMMs, you can provide hyper-concentrated liquidity. The idea here being, there's a swap that I know is coming. It's a really large swap. As a sophisticated actor, I can front run the swap, provide extremely concentrated liquidity exactly where the price, where the swapper is going to swap through. So extremely active liquidity. And because of how the concentration works, I'm representing like most of the liquidity that's being used for that underlying swap. And then after the swap has occurred, I'm withdrawing my liquidity and collecting the fees immediately. This is not an extremely profitable strategy because it is quite costly gas-wise. And you can also just do way more extractive and nefarious stuff that will be more profitable because the swapper is not getting more liquidity, but rather is losing out for different reasons. One of them is the JIT sandwich that Jared's a huge fan of. And you can see their profit margin being like significantly higher in general when they do JIT sandwiches. So basically the idea is you swap up to the limit price of the sandwich E of the victim. And you can kind of think of this as the intent of the sandwicher here is to maximize the average execution price of the victim, because that means that the discrepancy from true price is as large as possible, which means that they can backrun further down, right? So, but when you're sandwiching, you don't want to push the price above the limit because then the transaction will revert. So what the JIT sandwich lets you do is it lets you push the AMM price right up to the limit and then provide instantaneous, almost infinite liquidity at that concentrated point so that the victim is swapping basically all of their swap at the very limit of their intent price. And you would basically be getting a similar average execution price without that liquidity, but you'd push the price above because there would be less liquidity. So this means that they can manipulate the price even further, and on top of that, get paid fees on the swap that you're making. So it's kind of a double win for them. Does that make sense?
Yeah.
Any
Yeah.
questions
So,
there?
go ahead.
You mentioned concentrated AMM. So does that mean on UniV2 or UniV2 style AMs we barely see any?
It doesn't work.
Right. Okay.
Because I'd imagine it could work in in a setting where there's extremely low liquidity, but even then I'm not sure. And yeah, actually I don't think it would work, but you'd also just be better off just pushing the price up a lot further. But with concentrated AMMs, you can because you can represent like so much of the liquidity that is at that specific portion where the swap is occurring. So you're getting most of the fees. And you can also think of like providing liquidity as swapping, right? You're the counterparty here.
Yeah.
So Jared here also gets to trade at this ridiculous price against the other person and is therefore like making a really good trade by providing that liquidity.
So
Okay,
yeah,
that makes sense.
just like a straightforward example would say like a user in front end, let's say they're coming from 1 inch, and then the user got a price in the front end said, okay, I'm getting the liquidity for you from the Uniswap AMM pool, and you are buying a ETH at $2,000 USDC. And so that was the price users saw in the front end, and they were like, okay, confirm with a slippage threshold of some percent. Let's say like with the slippage threshold accept, the worst amount they will receive was like say at the price of 1,900. And so the sandwicher would try to push the price before user's transaction in the pool to the limit. Like say they will make the user to buy the ETH at the worst price they can accept. And then so in the case of I think, okay, sorry about that. I think I'll mark the clip. I think I should make an example of like the selling ETH for USDC. Okay, yeah, sorry. Okay, I'll mark the clip. So one
Do you
example
want to
is
use
that,
this one?
um,
Because here you can like see the mint, like the swap before, then the mint, and then the trade here. So it's like 1, 2, and then 2, and then 1, 2, 3 here. I can zoom in again.
this is also still complicated. I was trying to make the easiest example. So, okay, I'll mark the clip again. So basically, like say for example, if a user is trying to sell one ETH on say 1-inch front end, and they come there and this 1-inch said, okay, we got the price for you from Uniswap AMM. Say you're selling one ETH, you're getting 2,000 USDC, and users like, okay, cool. And then with a slippage threshold of like 1% or something, say the worst price I will accept is 1,900 USDC. If I'm receiving less than that, I'm going to revert my transactions. So to basically have like some protection, I'm not losing too much money. And so now this transaction goes to the mempool, and the sandwich searchers see it, and they will try to make a swap before the users in the pool to make sure the user is only getting 1,900. And basically they will make a swap that is taking all the liquidity out, that is a better price, say at 2,000, and then the user will price transaction going to come after theirs, and now user have to access the liquidity next to the ticker that was in the middle price, and the next ticker price will be worse, right? And the worst price is say 1,900, and so then user is getting basically whatever the worst price they accepted, and then later the sandwicher will try to like back to sell back the assets they got. And during these two transactions, they will get like a price difference in terms of like the profits. And so my understanding of like why JIT sandwich makes sense is basically we need to think about like the implication of all the MEV transactions in the LP aspect. So basically, if you think about like arbitrage in general, they are trying to eat one side of the liquidity compared to a fair market price. So like basically saying either say if it's atomic arbitrage where they are trying to arbitrage the price difference between two AMM pool, or they are trying to do sexdex arbitrage. They are trying to take the stale liquidity from AMM off compared to the Binance price. They are accessing the liquidity in the one side on one direction, and in that case, they are pushing the LP's price one side. So it's like the LP is getting LP fee, but they're also getting some like LVR or like impermanent loss like in the measure. But in terms of sandwiching, the sandwicher actually access the liquidity twice. So basically like they're pushing the price in one direction first, and then later they're selling it back. So in this case, like sandwich is actually healthy for LP because they're getting double the LP price. Okay, I see, Ludwig, you don't agree there. But my last thought is like, it makes sense for the sandwicher to say, I'm paying double the LP price. Why don't I just be the LP? So that's why they're like, let me just come in and submit a liquidity and become the LP who is being accessed and getting paid. And then I'm putting my sandwich here with a front user transaction, background, withdraw my liquidity. And so basically, I'm not only making the profits from sandwich, but also getting the LP fee I'm paying. But I see, Ludwig, you disagree on the point. I'm curious your thought.
Like, I think that more like the biggest point I'd like to make in terms of like why JIT sandwich makes sense, it's not only the fee. The fee is like a nice kind of bonus almost compared to that. Like the real value here for Jared is that they get to be the counterparty for the shitty swap at the top. So it's not only, and it's really more so about being the one that is fulfilling the really bad swap at this super inflated price point and taking the other side of that trade, right? It's like if a market maker was pushing you up to like a ridiculous price and then got to trade against you at that really stupid price where you're buying their assets at an extremely inflated a price compared to fair market value. So I think it's really that probably contributes mostly to their profit. In terms of like sandwiching being profitable and healthy for LPs, I think generally you can make a meta argument that it reduces the usage of AMMs because of the toxicity of them. But more importantly, you can, if LPs were like smarter and AMM design was better, the LPs would be better off like pulling their liquidity and not refilling it directly. But then again, sandwiches wouldn't occur. So I think that's a bit of a dumb argument, and I've seen it a lot of times, but I think it kind of makes sense. But mostly I'd say it's the toxicity side of things. Like it's pushing people away. If you're losing 50% of the value of your swap the first time you interact with an AMM, what are the chances that you're going to go back?
Or what are the chances you just set your slippage a little bit lower?
For an MEV searcher to actually do JIT sandwich instead of sandwich, if my understanding is correct, does that mean that there's kind of a tipping point in terms of trade size and slippage that basically makes sense to become a JIT sandwich instead of a normal sandwich? Or would that not be the case? And where like JIT sandwich are on much larger, older, or more slippage than normal sandwiches?
I'm not 100% certain, but my assumption would be it's like, as you said, like slippage amount and size, because you're operating with this like fee bound, which is related to gas costs. So how much are you saving? Like how much in gas are you saving versus just sandwiching? Like if you were to just sandwich, how much gas would you save? And then on top of that, how much extra are you making off of the fee and clearing the swap at the super inflated price? But yeah, I think whenever there's size, it becomes worthwhile. There might also be a consideration of like depth of the liquidity pool and how much you can represent of the specific active liquidity for that trade, which maybe comes into play. But yeah, we've mostly seen it for like really high size transactions.
Yeah, there may be some like cool research to do on like what is the like tipping point they're looking for, whether they're becoming a JIT sandwich to a normal one. Because I'm guessing there is in hyper optimized MEV bots.
Yeah,
there's definitely some optimization problem that has to be solved in order to compute what am I saving on gas versus how much am I paying in fees.
But this is only possible in kind of long tail pools, no?
No.
To do this could you do this in a WEF USDC pool? Because you need to buy so much concentrated liquidity from the pool, and like you'd pay.
That's a good observation, because basically like if the pool's liquidity depth is better, the more liquidity you need to buy out, or meaning the more inventory you will have to have as a sandwich to push the price off from the center.
But so long as you're pushing the price and then represent some portion of the like active liquidity at the top level swap, you should be profitable. Like the question then becomes like, how much am I paying for inclusion, right? But like it's almost always a win. It's like, oh, I'm pushing price super high. I'm then becoming the market maker effectively and selling you these assets at this really inflated price. You're paying me a trading fee for the luxury of getting arbitraged. And then I withdraw my liquidity, collect my fee, and then back run the entire thing back to true price to offset my initial front loading cost. That seems like if you told that to like a TradFi market maker and you explain them that they could do this, they would like laugh and be like, there's no way this shit is legal, because that is just ridiculous. And like speaking of examples of like ridiculous trades, I have here an example of a JIT. We didn't add the JIT sextex classification, but that's something that we also have. But this is an example of a JIT sextex classification, where it's SOXA69 Babe, which is Symbolic Capital Partners. And here, what they're doing is that I really like this example here because it shows that JIT and like sandwiching, JIT is bad for the swapper, and SexDex is bad for the swapper as well. And it's not just bad for the LP. And why that is that basically what SCP is doing here is that they're providing this instantaneous liquidity, and they're not doing this out of the kindness of their hearts to ensure that the swapper has less slippage. Rather, they realize that there is a price discrepancy between the pool's current price and Binance. And so they want to be like providing liquidity for this swap because the end swap will like be discrepant, and then they can arbitrage it back against a centralized exchange. And the beauty here is that they don't have to swap against the pool to do this, so they don't have to pay a fee to LPs. So they can do this even when the price discrepancy is small enough to be within the fee bounds of the pool. And when I say fee bounds, I mean the amount of discrepancy and how much profit they would make is less than the trading fee that they would pay when they're executing the swap, which means that the arbitrage is unprofitable. But the crazy thing here is that they're doing this like while building the blog. So you can imagine all sorts of funky combinations where they're doing this, and then they're pushing the price even further for the AMM, and then they're back running all of this with SexDex arbitrages. But they can kind of sequence the transactions however they'd like to ensure that people that are swapping against the true price are pushing the pool as far as possible, and then they can bring it back. And the greater that discrepancy, the more profit they make. Does this make sense? Are there any questions here? Oh, as you can see here, the builder tip. So that's one other action that we classify. But yeah, otherwise I can move to some other arbitrage, like MEV types, and probably go a bit quicker. So yeah, this is just a simple SexDex. This is Wintermute. They're trading WETH for mana. I guess takeaway on this and big thing that we learned was that you assume that we assumed that at least that SexDex only happened on like top tier blue chips. This is not true. You have many different arbitrageurs with many different risk tolerances. You have some that you will see literally direct deposit to their KuCoin address, like within the same transaction, and they're trading, like, pardon my French here, but absolute dog shit. Like top 2000, low liquidity, Bybit listing garbage, and they are just holding it for an extremely small period of time, and are really profitable. And you can see really nice profit margins on those as well. So that was really cool to see.
How do you programmatically determine these?
Yeah, I
SexDex?
was gonna.
Yeah.
Yeah, you want to go? You got it.
Yeah, so there are two methodologies that we use. First is just simple mid-price and then markouts for T2, T12, T30, and T60 and T500 in the future.
Sorry,
in terms
again,
of, like,
in non-technical
in English?
terms. Yeah.
Sorry. It's actually really simple. We take the mid-price of the most liquid venue for that pair over the recent month, and we look at the instantaneous like profit realized. And when I say instantaneous, I mean the time at which the bid was submitted to the relay, to the first relay. We use that time stamp and look at the price on the exchange. And then we look at the price 2 seconds in the future, 12 seconds, 30 seconds, 60 seconds, and 5 minutes. And we use those prices to evaluate profitability over these different timestamps. But we use the like bid submission one as the anchor, which will like result in a classification. So if they're not profitable instantaneously, but they're profitable 5 minutes after, we won't classify it, except if they're like a known searcher with like a very high volume of successful and profitable bundles. And then there's all sorts of heuristics that we use to filter them out. The second more complicated strategy is like our experimental one, where we do volume weighted average pricing, where we have like this dynamic time window. So instead of just looking at a specific point in time relative to when the trade occurred, we have this time window that will expand if there isn't enough volume on the exchanges. And this is useful when you have like extremely low liquidity tokens, where the arbitrager has to spread out their hedging on the centralized exchange, because otherwise they'd impact the price too quickly. And so it can expand up to like a minus 20 plus 30 seconds relative to the block time. And it's really funny because you see like on when you look up the trades for like certain like low liquidity tokens that they're arbitraging, they're like 99% of the volume. So it's just like SexDex activity on both sides, which is really fun to see. Yeah, and then we have like other parameters that you can play with the experimental, where you can weigh like the prices closer to block time more or less, and various other things that you can play with. But it's like super parameterizable, and you can kind of go crazy with it. But yeah, that's most of classification. The heuristics is mostly just like filtering based on known addresses, etc. But we really wanted to prevent any like whitelist based methodology, because that just isn't scalable. So we don't use like known addresses as a way of like systematically identifying them.
Okay, so this is kind of conditional of having all the price APIs from all the different centralized exchanges, and you just call them and you're like, okay, like, are these prices kind of similar? Is there a delta here? And then based on that, you're classifying this, like this transaction probably happened because there was a ARB to be ARBed here.
Yeah. Yeah, Joe, you want to touch on that?
I mean, there are some outliers, of course, to that, but yeah, for the most part, that's how we do it.
Yeah, super cool approach. I didn't even I hadn't even thought about like that. Do all the exchanges just have open price endpoints, and like also for like historical data?
Yeah, so none of them have them for historical data that's past I don't know what the time frame is. But they all have WebSockets that you can connect to that will stream price and quote and trade data and L2 data, I think. But the first methodology Ludwig mentioned uses the quotes data, while the latter uses the trades. So yeah, we have a few servers like in Tokyo and just somewhere else that will stream the price data from Coinbase, Binance, KuCoin, Bybit. The API for that, we made like a combined one that's on GitHub if anybody wants to use it. But
yeah, that's super interesting. I think pricing assets in crypto in general is like a hard problem to solve, and like this looks like a very kind of holistic approach, and classifying SexDex arbitrages using this methodology of just like, what are these people probably doing? And it's like they're doing the same, right? Like they're calling these price functions of the APIs, and then based on that they're looking at the on-chain state, and they're like, okay, like there's money to be made here. And you like, it seems like you're just replicating that approach and just using the same methodology to then just classify these trades. Super cool to see.
Yeah,
reverse engineering it in a sense, I guess.
Yeah, because one point of clarification is like we don't like evaluate based on pricing if an arbitrage is possible, because then like it kind of blows up in terms of like the amount of things that you have to evaluate. So we just look at like historical trades and say, okay, this trade, what's the execution price for this swap? Okay, what is the price on the exchange? How much more or less are they getting? Like, how different are the rates? That minus the transaction cost, does that render the transaction profitable? And then like for the fancier way, it's just a different way of calculating price, really. But yeah, I think you can get like really good results with a purely programmatic approach. You just need a bit of filtering, because a lot of like, there's some weird stuff that can happen, where like these random people will do trades and just get lucky, and they're like, and this is more like way earlier on when markets were less efficient. Now it's like arbed away, so they don't really get that chance to get a really good price. But yeah.
Yeah, accidental SexDex arbs, but then you just hold the token, like that doesn't.
Yeah.
Something.
We've had a few. Yeah. We found a few of those. And yeah, it's the most painful thing in all of this is getting a unified representation of like listed pairs and centralized exchange data to like token mapping representations, because you can't just rely on symbol mapping. You need like a hard-coded like address to listing. We did the symbol mapping approach first.
It was
No,
it did not work.
Don't do that. Yeah. And then lastly, atomic arb. This is probably the biggest abuse of terminology on our part. We call atomic arb a lot of things and nothing at the same time. And it is also by far the most likely and prone to have false positives. Although we fixed this yesterday before we came on the podcast, but it is still loading right now. So we'll see the results soon. So the different forms of atomic arbitrage that we classify, and what an atomic arbitrage is in the first place, is a transaction that atomically is profitable by executing a sequence of interactions or swaps that ends up with them having a higher balance of tokens, and that balance of tokens being more valuable in some dollar term or whatever denomination that they're using to account. And like my description here is like purposefully generic, so that our classification doesn't seem too crazy. But yeah, we're pretty loose with the classification. We break it down into types, into triangular arbitrage, which is like you buy a token, then you sell it on a different exchange, and then you end up with a higher balance. So it's like the typical where you do a closed loop. Then there's like cross pair arbitrage, where you're basically extracting the discrepancy in pricing between two separate assets on like two separate venues, as opposed to returning to the original asset. And then there's stablecoin arbitrage, which is just a specialized form of cross pair arbitrage. And then finally there's long tail, which is basically everything under the sun that happens to be atomically profitable. And how we classify these is that we have a pricing module that we built that will like look at all of the on-chain pools and calculate the kind of liquidity weighted instantaneous price by identifying the optimal trading route that you can take that is like the deepest in liquidity, and it will use those prices to evaluate the profitability of a transaction, comparing the pre-transaction value and the post-transaction value. And importantly here, we don't just account for like balance times like a fixed price. Our prices are actually granular at like the transaction level. So you have a price before the transaction occurred and you have a price after the transaction occurred. And that's quite important, because then you can take into account the impact that the transaction had on the market and on the pricing of the underlying tokens. But yeah, it's a pretty wide net that we cast. And the pricing can bug out when you have low liquidity stuff that messes up the calculations. But we tried our best to kind of iron those out, and we're going to be working in our spare time to make this even better.
I am curious for atomic arbs. So I worked on those a bit last year and surfacing those on Dune using like a looping function, but I only looked at things where the first and the last token was the same. Do you do any like kind of pairs or bundles of assets, like, I don't know, ETH and wrapped ETH, for example, where, you accept that, it starts with ETH and ends with wrapped ETH, or vice versa? Do you do any kind of like bundling of these kind of assets, or how does that work in terms of, is it all manual? Do you do none of that, or yeah?
We don't do any manual like mapping of tokens. The only mapping of tokens, is the stablecoin. So we just classify what constitutes a stablecoin, and we break that into types. So you have dollar stablecoins, gold denominated stablecoins, euro stablecoins, and then we can evaluate arbitrages based on like the like dollar to dollar, assuming they're one-to-one type of profit, and then the like gold to gold or euro to euro. But otherwise, we don't have any like fixed mappings. We just classify them like to tag them. So if there's a full loop, we consider it a triangular. If it's a cross pair, so asset A to asset B to asset C, and you're basically arbitraging the like exchange rates between those two, and you're getting more of that other asset, but you're not returning to the original asset, we'll tag that. And then for long tail, we basically accept anything under the sun that ends up with a profitable token delta balance with heavy filtering though. And I think that you need to do that to get the interesting stuff. And that's why we had a lot of false positives, but at the same time, why we found like the like cooler stuff that we were really, really excited to see, that kind of challenged the assumptions that we had on Atomic Arb, where we always assumed, oh, it's like the most obvious, the most competed away, lowest profit margins. We actually found that like it is where you have the largest distribution of searchers, so biggest diversity in terms of like searcher base, because there's so much creativity involved and so much alpha in being the first to move and doing like the craziest shit. So yeah, we have like way more coverage than any other like MEV explorer in general, but specifically on Atomic Arbs. But that does come at the cost of like false positives, especially with routers that kind of mess shit up and like dubious pricing at times. But those things will be fixed in due time, hopefully.
Yeah, that makes sense because like Atomic Arb is also like the longest history and like most competitive one that people are competing. So yeah, as actually to that point, I was gonna ask like how does the numbers benchmark with other existing tool like like MEV seems to have a good reputation from the searchers, mostly because Jared was in one of the interviews and said, oh yeah, that was good. So it's kind of like a trust me, bro case. But yeah, I've heard good comments about them. And there was Iconfy and MEV Inspect as well. So would you expect, like, I guess sounds like atomic MEV value here on Brontes would be slightly higher than others, but also like Sextex doesn't exist on any of those.
Yeah.
Yeah.
I think our atomic number right now on the website is definitely wrong, like 100% wrong, like definitely overestimated, likely 2x. For the simple reason that like, although like 99% of the stuff we classify is correct, the pricing bug that we have when we weren't like sufficiently filtering out low liquidity stuff would mean that like your profit's like 5 million for a bundle. And that skews everything so much that even though it's like very small volume wise, it represents so much of the profit. And that was super frustrating, but we're updating that tomorrow with our fix that should fix that. Yeah.
I think as far as the front end goes, that number on the front, what we're just talking about, I've actually where we trimmed out the absurdly large atomic arbs. So I think that it might be quite close to accurate in terms of as far as the number goes for the atomic arbs.
Got it. Yeah, I mean, appreciate the honest information and like from the being being responsible as a data provider. And I mean, yeah, this is a good call out for anyone in the space that can help contribute, just create PRs and like say, hey, this can be improved in this way. That will make everyone's life better. Yeah, I think also like we're curious about some like high level takes based on the data you guys built. Like I'm curious what are some highlights from the data. For example, who are making the most money right now across all kinds of MEV and across the supply chain? Like if you guys have any, like say, how does the profit margin, for example, specifically compare across different MEV? Are searchers having higher profit margin, I assume, on Sextex compared to Atomic? Yeah.
On average, yeah. On average, Sextex is higher profit. Who's making money? Simple answer, SCP and Jared right now. They're printing money. You have a few background bots that do really well as well. In terms of like highlights, I'd say like some builders like that when you look at their like raw P&L and don't consider MEV, they like seem like they're I think proposer cucks in some sense, as in like they're just like outrageously subsidizing and it looks like they're making no money. And we were like, why are these people even doing this? This is absolutely ridiculous. They're just bleeding money. But then you kind of look into it in more detail and you realize, no, they're the ones having a good time. I think specifically of ICANN has block. It's a builder with very low volume, builds very few blocks, but the blocks they build are beautiful. Yeah. That's honestly works of art. And when you map, so they're vertically integrated and they operate a generalized front runner. I think called Yoink.
Yes.
Is the name. and they just do some really cool stuff. Like they front ran a Ronin bridge exploit a few months ago. That was like a 700 ETH block, and you just see stuff like that, and you're like, wow, like this is so cool. It's a shame that we don't like look into this more, because like for all of the problems that MEV creates, there's some really cool parts that are somewhat positive. And you can also just see the like underlying creativity these people express through how they design their stuff. Otherwise, like it's mostly boring takes on like stuff that people assumed in the past and is generally accepted. But yeah, if you look like in detail, there's some quite interesting stuff going on. Joe, do you have any other general takes?
I think the different composable types of MEVs is quite amazing. There's super creative ways that these people are coming up with just to make money on chain, right? Just sex stacks being one of them. And had it not been for us being like forcing ourselves to build out the other components of this, I don't think we would have realized that a lot of these newish, unheard of types of MEV are occurring, or these methodologies might not have been recognized. We might have thought that it was just a regular JIT, but this allowed us to see another component of the MEV that we wouldn't have recognized otherwise.
Yeah, like we love making like stupid names for the new types of MEV that we find. Like one of them is like Big Mac for like for Jared's sandwiches. And so you can think of a Big Mac as like the bread's on top and on the bottom, but there's also that slice of bread in between. And so what they'll do is that they will like front run like multiple victim sets, but those victims have different like slippage tolerances. So they'll push the price up for the first victim set that are like have like a tighter slippage tolerance. Then those trades will execute, and then they will push the pool's price even further to the like even less informed victim set, so that they can like do the entire thing in one bundle. It's like stuff like that. You're like, wow, like you really have to think about that. And it takes us a bit when we're like misclassifying stuff, and we just have to stare at it and be like, what are they doing? But it was really fun.
Got it. So you would see a bundle of like Jared's front run and like victim, but also Jared's just swaps in between, just adjusting all those like price ticker for the users to take the most out of it.
Yeah, it's like a layered front run, kind of like push price first, most like tightest slippage tolerance victim first, continue pushing price, looser slippage tolerance victim, and then back run the entire thing. And there's like certain sandwiches with like 60 victims that we found. Like this stuff is like full blocks, I don't know how much gas has been wasted, but it's insane. Like we talk about Ethereum scalability a lot. Like if you got rid of the bots, you'd have like a lot more block space. Like there's some like tokens that try and get around like the sniping problem. The MEV bots always find a way. Like the limited quantity tax token technique, where basically like token deployers will identify how much you're trading, and if you trade more than a certain amount, you're considered like a sniper bot. They will literally fill the block with separate swaps up to the very limit of the amount that is created on the contract, and they will just swap in that exact amount 100 or like 1,000 times so that they don't get the tax. Like so much ridiculous stuff that you can find.
Yeah, I just realized Jared is such a genius name, because like Jared is a guy from like the real life, sandwich shop called the Subway. I don't know if Europe has that, but Subway sandwich. You don't know that?
Jared from Subway.
Wait, what? You don't know Boxer?
Boxer, you don't know?
You've never had
Jared
a Subway?
From Subway.
Subway?
I know Subway, but maybe he's called like some German name in Germany. Maybe I don't know.
No, yeah. And then this guy, this sandwich MEV searcher, he's like the experts making sandwiches, like all kinds of sandwiches. So it's really making a lot of sense now. Yeah. Okay. Any spicy takes? I know you mentioned that they're trading all kinds of shit coins, like the SexDex searchers, which is I guess like a thing that people wouldn't expect. Is there anything that's you guys learned from something that's like people always thought this way, but it's actually wrong. Like that's not true. Yeah, that kind of thing.
So something for me, I saw and I was just like, it kind of went against my intuition at first, was that some of these searchers, they hold inventory on these absolute shitcoins that rarely see any volume. Granted, it's only temporarily. But yeah, I thought this was an interesting thing that would go against anything that I think most people would think.
Right. Yeah, makes sense.
Yeah, for me, I'd say like atomic arb is dead, and like the idea that that's unprofitable, definitely wrong. I'd say like cross-chain MEV, I think is just like complete psyops, and doesn't really make sense. This idea of like, oh, we can like combine multiple chains, like the whole like shared sequencing narrative of like, let's take multiple chains, sequence them atomically together, and the emergence of value by cross-domain MEV will be like greater than the sum of its parts, I think is like a bit of a BS take, for the simple reason that like transaction cost and swap efficiency on chain is ridiculously bad compared to like the most liquid off-chain venue for the time being.
Yeah.
And probably for a while. And with that in mind, and with the assumption that like trading is just that much cheaper off-chain, you're basically always better off doing centralized off-chain to a given layer and arbing that discrepancy and doing that for the multiple domains. So that's, I guess, I don't think it's that spicy anymore. It's probably somewhat accepted. But
wait,
yeah.
so what you're saying instead of sorry. So what you're saying, instead of me going and kind of arbing base and ETH prices, like if I see some discrepancy between those two, I would rather kind of go from base to Binance, like do that trade, and then the same with like ETH to Binance. It's never worth it to basically like run two separate searcher instances on two separate chains and try to make those like compatible with each other, just because like the infrastructure is, or like, is it the infrastructure or is it the kind of cost overhead?
Just cost overhead, and also like you're competing with specialized people that are doing like base to Binance.
Yeah.
And so they're paying less. Like, I feel like there might be examples of this in the wild. Maybe, Flashbot sponsored, maybe, other entities that like wanted to show that it was possible, like as like hackathon projects. I'm sure like this has happened in the past, where like like the jam sessions where they were like building MEV bots, and like they're really cool examples of stuff that you can do. But in like a hyper competitive market, it just doesn't make sense. The only thing I could imagine is like these really weird, like composable long tail stuff with tokens that aren't listed.
Yeah.
But that stuff, it's not that significant. It almost never is.
Yeah. So like the only thing I can think of is like tokens that are not listed on exchanges, right? Like that's a case where this might actually make sense. But how many like significant tokens are there that are not listed on an exchange? Yeah, that's fair.
Yeah, so basically there's like three cases, right? So it's either the blue chip major token that is listed on Binance, and you're saying why not they just arb on like L2 to Binance rather than L2 to L2, like because the L2 price, how accurate or how true the price really is, can you know? Second is like if it's a long tail token that only exists in one chain, you can't really do arbitrage across other chain. And the third case might be the only case where like L2 cross chain arb makes sense, which is like some mid long tail that maybe say exists on both on base and optimism, and that's the only thing you can do across chain to arbitrage, but probably really small. So and so basically your spicy take is that what I heard is that like the money raised from the VC with this L2 arbs narrative might be bigger than the actual L2 arb volume.
100%. I'm quite confident in that take actually. Like, yeah, like that money raised, for the matter of fact, I'll go further. The money raised from VCs for cross-chain like sequencing with the assumption of like composability generating additional arbitrage value is greater than atomic arbitrage in like since the merge, probably. Like, and I say atomic arbitrage full stop, like general atomic arbitrage. Like people think that MEV is like this massive deal. And I think the nerd snipe is because it's cool, but it doesn't matter that much. It's not that big. Like, it is, people have widely overestimated it in terms of the value that it's generating. And it occupies probably more mindshare than it should, but it is really fun. So we have a great time. I guess that the leaning into that take, the other like spicy take, but I think it's also coming to be accepted, is that we don't need generalized solutions for MEV. We just need to deal with like the negative externalities, because it will all be solved at like application layer. And if you look at the data, it's always the same stuff. There are only very few types of MEV that actually matter. It's atomic arbs, sexdex, and sandwiching. And that's basically all that matters. Even liquidations aren't that important, although they're somewhat like easier to fix. So it's probably worth it to do it, but they just don't matter. Like most of them, it's really inconsequential.
But in a very long-term future where a lot of the trading has moved on to on-chain, and you got higher performance blockchains with like much lower costs, it probably eventually makes sense. Just isn't like a crazy huge deal as people are making it. Right?
Makes sense to do what?
I mean cross-chain arb.
Cross-chain arb. In a world where there's no like off-chain trading and those are the main venues, sure, but even then you won't need atomic settlement cross-chain. You won't care, because it will be cheaper to do it like with just like two addresses, and then managing them and like having a view on both states, and then like being able to arbitrage like those layers independently. Because I don't think that like the atomic composability side will matter in those arbitrages. And I think that in general here, there's like a really big assumption that I hope it like realizes itself, where like on-chain trading becomes the predominant trading venue. But it's really tough, right? Because you're fighting one box performance versus like replication across the world and network overhead there. And that does suck in terms of computational overhead and latency.
Yeah, makes sense.
Cool. Yeah, I love this debate about L2 MEV. So another thing I guess like to ask is like, is there any trend you guys observed from the data set over the past 1 year, 2 year course? Is there, for example, like has there? I assume actually something I observed in the past was like the atomic arb profit margin for searcher has been going down and down. They're paying more and more to searcher proposers because it's getting more competitive, and everyone needs to bid out to make sure they got included. So another thing I think like related would be, it seemed like, I'm not sure, but it seemed like sandwiching has been dying down, or at least what I shared the other day on Twitter was that if you look at a Jared's flow value, meaning basically how much Jared is paying out to builder than proposer, the value seems to be kind of trending down in the past 1 year. And that kind of correlates with the movement or the development in the market where like the order flow become private. So like we know like MetaMask now have smart transactions, which is basically they will ask user to opt in. And if user opt in, they will take control of the submission, not to send to the mempool anymore. They have this somewhat kind of like a auction towards different block builders, and the builder will have to bid on top of getting the flow. And whoever the winner is will get the flow exclusively. And that's all I know from their public docs. I don't know any details about like what's the numbers and arrangement, but we would like visibly see a lot of order flow moved into private liquidity. Maybe I can quickly share something here. So, for example, if you compare these few charts, basically, this is what I was talking about, where Jared's value flow paid out to builder proposer has been going down. If we track their, MEV bots. But so then the control variable is that maybe that's because DEX trading volume is down, but that's not quite true, because we accounting these value from Jared is in ETH units, and the trading volume in ETH units over DEX has been pretty flat. So it's been kind of stable. I mean, if you have to look at it, it actually goes up in USD volume because ETH price has been going slightly up this year. So yeah, the flow value has been going down, but it's not because of DEX has been going down. And if you also compare like the private transaction percentage on Ethereum, it's been going crazy up like this year. So starting from beginning of this year, it was still around like say 15% of the transactions are not observed in the mempool. So they are in private mempool. Up until May, this number has been going up now actually around like 33% on a daily basis. And I mean, if you zoom into the type of transactions that are related to MEV, which is DEX swaps. So you would see that actually like all the DEX swaps by transaction count went up from 40% around April up to now like 80%. So like 80% of the users' DEX swaps are now in private mempool. The intuition here is that less user victim transactions in the mempool, then there's less sandwich for Jarrett's to make. So I'm curious, like if that's true as how you guys observed in the data set, and if there's anything relevant that you guys observed, like from all these order flow markets development.
Yeah, I mean, I think that intuitively this definitely makes sense. A lot of the uninformed flow is going to come from things like MetaMask and similar wallet UXs. And if they're submitting their transactions privately, then there's no chance for Jared or any other sandwicher to see them, right? So I think with that you'll definitely see a decline in their activity. However, I'd have to go and do some analysis on the data to see if this is always the case. But I mean, intuitively, this definitely makes sense. I know MetaMask is one of the largest wallet providers. So, I mean, I assume that would definitely cause a decrease in activity as far as searchers go. Either that or he's just he's getting lazy. One of the two.
One thing I'd say is like private doesn't mean safe. And so even if they're not in the mempool, there are different ways that you can find a way to make a pretty penny. And
are you
of all the
suggesting
people,
there is sandwiching happening in the private mempool?
I would not be surprised if there were ways that specific actors got access to like the block template, so that they could sandwich private order flow. Although I'd assume that top builders are not doing this because obviously you're not going to send their flow to them. But I think that you can move away from just baseline sandwiching, and then it's more so a question of ordering to the benefit of arbitrageurs, where you're entering mostly games of maximizing sex value. And so it's not so much that your price is getting pushed and then it is a clear sandwich, but rather you are part of creating greater discrepancies in the AMM market to maximize sex value for the arbitrageur,
right,
which implies that you're getting a bad price and you are pushing the price further in the wrong direction, which is definitely suboptimal for users. So with that in mind, and with like the centralization that we've been seeing, where Beaver and Titan have been dominating even more because Wintermute seems to have fallen off the top stage in the last 6 months, I'd assume that actually profit margins might have increased. Again, I have to look at the data there, but I wouldn't be that surprised if profit margins slightly increased for SexDex. And then there's a lot of profit that is really hard to quantify. Could you scroll to the other chart? And just to understand that all Jared's flow value, like, so this is denominated in ETH, but how are you accounting for that ETH? Is it just payments, or is it like the ETH value of the tokens that are being moved around?
No, these are all the payouts they sent to the builder tip and plus gas. So like it's basically whatever the profits out of Jared is paying out of their total profits. So it's more like an approximation of saying like it seems like Jared's paying less nowadays from their sandwiching profits, and I would assume they're making less money in general. But I guess there's a layer of assumption there that they are paying the same margin. But
I guess this is likely true, but they've also like been like crushing it so much with the more complex JIT sandwich types. And I wouldn't be that surprised if they were also trading on centralized venues.
I see.
Because it's just like the maximally profitable thing to do, right? To JIT sandwich and then also, end up by arbing the price back to like decentralized price,
Right.
where I think that there might be like a lot of additional profit that they've been able
I
to
see.
extract
I see.
that isn't necessarily directly visible.
Got it.
Yeah.
Right. So you're suggesting like the total value they're paying out might not only just because the sandwich flow has been going down, it might be because they find other niche that they can keep a higher margin.
Yeah, but I'd still agree that like generally
Right.
it is likely that it is trending down across the board,
Right.
and will continue to trend down, especially as, as like the applications evolve to counteract this.
Right. Yeah. Okay. Cool. I think we would pretty much wrap up with all this learning from Brontes, and I guess the last few bigger picture question for you guys is like, I understand that like all these data digging and research on Brontes is more like also to serve the foundation for Angstrom's design. And so with all this learning, how are you guys thinking about tackling the MEV implication on users? I know that you shared about some details earlier about like say basically to be able to capture the MEV and also to categorize the flow from the user, do some frequent batching. Any other thing you can share, or like maybe more specific, like how does a user like us to expect, like what does the UI or interaction would look like for Angstrom? Would that look like a normal DEX in front end?
More or less, the swapping, UX, like when you actually go to do the swap, it'll feel like a regular deck swap. We will have some more components and hopefully some more analysis that we'll be able to show as well. Now.
Yeah,
Got it.
you're not like sending an actual transaction though. You're signing an intent. Like you're just signing a message, and you don't have to pay any gas. So it's all gasless. So if you have 0 ETH in your wallet, that's fine. However, obviously that is being charged on the output or input of your swap. But the great thing here is like you're mutualizing gas with searchers and every single other person that is swapped on that pool and all other pools within our system for that block. So if there's like 30 people that are swapping on a given pool, you're basically just paying for the transfer costs, and then you're splitting that base swap cost across those 30 users and the searcher. So it gets really cheap very quickly. So yeah, I think that's like the main difference in terms of UX. The other thing is like composability in the beginning is not going to be available, where you can't swap and then atomically interact with other state. But we have like a bunch of solutions in mind that we're building out now, which should enable you to do so. Yeah, I guess that's most of it in terms of UX. In terms of like lessons that we learned from Brontes and impact that's had, biggest one's probably just realizing that Angstrom is useful for more pools than we thought and more assets than we thought, because we were first targeting just like the highest volume stuff. But even for pegged assets, even for like middle of the pack that are still listed on centralized exchanges but see less volume, they're clearly getting arbitraged by a lot. So there's definitely value in recapturing that. And even for stables, for the like one-off black swan event, that's a lot of revenue that you get to recapture. I think that's probably the biggest lesson. Yeah.
Got it. Cool. Any like alpha on like when it will be launched, or when should we expect the thing to come out? You can say no, because I feel like when I just met you in the beginning, I asked you anything about the details, that you will be like, it's a secret, like wait for it. Actually, there's a fun story I've heard. I don't know if that's true, but anecdotally, the Sorella team was like trying to talk to the investor, and the investor was like, okay, tell me more about it. But they basically used some tactics saying, no, it's a sealed bid auction and you will have to commit first, and then I'll tell you what we're going to build. And was that how the deal was done?
We can neither confirm nor deny. Yeah, I don't know. I don't remember. I forget.
Okay. But I think it will basically launch with the V4 hook launch, which I think it's being expected by later this year or earlier next year.
I'd say like, yeah, late Q4, early Q1. A lot of stuff to build, a lot of audits to pass. But yeah, hopefully very, very soon. And hopefully we see a big dip in just raw extraction that goes also the propose and build up. Because why are we paying these people? They don't deserve it. They're not losing the money. It's like, what's the point? Let's just give it back to the people that are actually losing a lot of money. So yeah, if you're an LP or a searcher, hit us up. We'd be more than happy to work on integrations and help you on board. So you don't have to pay the builder or the proposer.
Cool. Any other comments, question from Boxer and Dolby before we go to the chart crime section?
You mentioned that DEXs are definitely where the bulk of these are the bulk of MEV. Have you ever considered looking in, this is more tail end, but there's other, MEV kind of types, although it's like maybe more sniper bots. I think like Frentech had quite a bit of sniper bot activity. There's also like Zora, being like the first minter kind of thing. And like there's very different type of MEVs across all over the board. Are you interested in this at all, or are you solely focused on DEXs for now?
Yeah, no, we're like interested in like classifying as much as possible. Most of it, like the stuff that we didn't classify, is just we didn't have the time. And I think it's mostly because we spent so much time with building the core like primitives of the classification model. Because now you kind of have a like feature complete block explorer, right? You have to classify every single transaction at the trace level granularity. So you have like all of the centralized exchange pricing for the top, and then all of the DEX pricing at transaction level granularity again. Like you can kind of go crazy with it. And we just wanted those building blocks to work, but we'd love to see like longer tail stuff. Our concern is that it's probably going to be kept private because there might be like a good amount of alpha there. But we have like a nerd snipe milestone in the GitHub repo with the sniper bot as like an issue, and long tail, but we don't have the time right now.
Okay.
But if you want to build it, we'll definitely help.
Okay, why not?
Sure, easy. Any hot takes from you guys on the kind of general trend of sex and DEX volumes? And like DEX volumes are increasing, right? So how fast, like, do you think this development is increasing, or are we going to stay in this? I don't even know, like, is it 20% DEX, like 20% of the global DeFi volume is DEX volume and 80% is sex volume, something like that?
So I guess the question is like basically if the DEX volume will take over and the flip compared to the sex volume.
I don't think anytime soon. Hopefully in a few years. But as of now, I don't see an indication of that happening. Not to speculate or anything, but yeah.
I think Angstrom will onboard the next trillion. So I think as soon as we launch, we'll probably flip easily. I think we're actually in a flip TradFi by probably first week. So yeah, those are my thoughts on that. No, but seriously though, I think most of the DEX volume increases are just like increasing sophistication in arbitrage and innovative ways to extract money and do wealth transfer from uninformed retail to the best like HFT shops and MEV shops. So I think that you can throw probably 70 to 80% of that volume in the bin and label that toxic flow. So yeah, increase, yes. Positive increase, not necessarily. Probably, I mean, top Uniswap counterparties / like traders are Jared, SCP, and Wintermute, like literally top 3. Which, it sounds bad, kind of makes sense, but is also like kind of wild when you see how much it is compared to just like general volume. You can see it on Etherscan when you go to a pool and you look at like transactions for the contract, and then you just see execute FFS yo, like for fuck's sake yo, which is their function like selector, and it's just all of the transactions. And I will like regularly go on pools when I'm like checking an ARB. I'm like, this might be a false positive. Look at transactions. 50 of them are the same address with same function signature, and we all know what's going on there. So we're getting there slowly, but I think we need like sustainable and like reliable markets before we can get anywhere close.
I mean, I sense strong new DeFi builder vibe from the bold goals or like the ambitious goals about adoption. But I feel like people who have been in the cycles of a few bear and like bull market cycles are much more burnt out from those, like the DeFi founders. But yeah, I appreciate the bullish energy, and of course, like hoping that will be true. Okay, so I have a chart crime that's related to MEV data that I want to share. So basically, there was this tweet on basically some L2 MEV numbers, and I basically had some discussion in DM with Mohammed. He's a analyst from Delphi Digital, and we were pretty much just looking at actually the data set that Dolby built on Dune. But one specific thing to call out is that like in Dolby's data set, it's talking about trading volume. It's not talking about like the revenue from searcher or profits from searcher, right? You could derive those, but pretty much like the most thing to note here is that it's about like when we say like there's 3.9 billion atomic arbitrage volume, it's about trading volume. But I want to say like the trading volume for MEV doesn't make sense pretty much, or it's a vanity metrics similar to TVL, right? So actually like Yuki also from Sorella Labs had a comment here, which is basically about this point. It's very easy for people to mislead, to think that, okay, there's like 3.9 billion arbitrage revenue extracted by searcher, but really it's about volume involved in the trades or swaps. But if you think further, it's actually a counter, index, because as what we discussed earlier with Boxer, the deeper liquidity it is for some pools, the more volume it will occur when you try to do a sandwich. And so actually the higher volume on sandwiching is a healthy index for less, for the pool, if that makes sense. Because like the deeper liquidity it is, the better the pool is for the users to access price without much like slippage or anything. So like for example, if you look at here, if we look simply at a one sandwiching transaction, say this one, like Jared is sandwiching a 0x user who unfortunately sent the transaction into the mempool. If you look at the first transaction, Jared spent like this much money into the pool, and so basically Jared got this much USDC, so 7,220 USDC, and in the end, how much profit does he make really? It's like $20. So like he spent $7,000 to make $20. It's just saying that like sandwiching is actually very not capital efficient MEV strategy, and if you're reading into like the MEV volume, it's not really a good index to say anything about MEV. But yeah, I mean, I appreciate the shout outs on public in Twitter, but I think we should probably be careful when we talk about MEV volume, if that makes sense.
I would like to defend my data sets.
Yes.
So that my goal was never like to single out profit here, but like Ludwig said before, like labeling kind of this DEX volume and trying to make sense of what percentage makes up MEV, what percentage makes up the rest, and whatever. Kind of similar to I did this on NFT where I labeled like wash trading, and here I'm trying to segment out DEX volume into retail, MEV, and other kind of things. And I mean, it's been misinterpreted a bit, like just the data set. The way I published it has been fairly clear that this is my intent, but whatever, I guess since it's on Dune in public, anyone can use it and misinterpret it just from the name. But yeah, it is what it is.
Isn't there like common joke about sandwiching? Like moving the like GDP of a small African country to make 12 cents? Like when like they're flash loaning like 50 mil or 500 mil and they end up like post cost with like $12, or like I think I saw one where it was 50 mil and it was 12 cents in profit. Like that's wild.
Paying like $12 probably in gas fee.
Yeah.
Well, wait, Denning, so the argument you were trying to formulate is sandwich volume per se is not a good measure of kind of anything, because like the cheaper the fees, the higher like the volumes can be. So like by definition on layer 2s, there's going to be like high sandwich volumes, just because like if you do a swap like this where you like spend, or like your inventory is 50 million, or you might even flash loan money or something. So like the like cheaper the costs to do this operation, the higher the sandwich volume is going to be.
My point is like basically saying like the sandwich volume doesn't directly correlate. I guess there's some correlation, but it doesn't reflect how much profits and exactly how much like slippage users are suffering or anything. It just says how much you have to spend to move the liquidity in the pool. Because the higher volume it is means you have to make a bigger trade to cross the ticker, which means the pool is more concentrated, which means it's a good metrics for the pool. So it's kind of like a counter actually indicator, if that makes sense. Because like people usually would think the higher volume for the sandwich is worse because more sandwiching, more user suffering. But it's not true. It's actually meaning that the pool is pretty healthy.
You're probably right, like across the board, but I think that there is a consideration to be had in terms of it also being somewhat of a proxy so it's proxy for liquidity depth, sophistication of end user in terms of slippage tolerance, and then availability of flash loan liquidity. And then finally, if we're USD denominating this stuff and you're using the price of the pool as like the value of the asset that is being pushed through, right? If the slippage is really wide, then if you're marking it at like the peak pricing, I hope like you probably wouldn't do that most likely. But if you do like some weird stuff where you're like marking the value of the assets in terms of USD volume at like peak volume price, then it's mostly like a slippage tolerance proxy. But I'm assuming it was done correctly. So I think, in most part, you're probably right, but there's that tiny consideration.
All right, kids, be careful when looking at MEV data. And with that, I think this was another episode of the Index podcast. Thank you for listening. Thank you, Joseph and Ludwig, for coming on. I think we certainly, or Dobby and me are mostly the pupil here. We are always learning about MEV on these episodes. So I certainly learned something today. I think the data pipeline that you guys built is super exciting. I wish I had that in Dune. I'm thinking if we could host an instance or something, we could. I mean, it's open source, right? You guys wouldn't be offended or anything. So
I'd be more than happy.
Yeah. I don't know. Always cool to see, and I'm excited for the launch of Angstrom to see on-chain volume go into the trillions and to bring on the next billion users, and they can trade in peace from the MEV searchers. And Jared is finally gonna have a bad day, I guess. Thank you everyone for listening. Thanks for coming on. Catch you in 2 weeks. Bye bye.
Crypto day wizards, come join us for the parade. From Bitcoin ETF to Solana meme coin trade, uncovering public secrets in the blockchain shade. Bad chiller, cherry picking liar. We call them out and set chart crown on fire.